Hello guys, Dividend Enjoyer here, and today I'm going to be doing a stock analysis video on Enbridge, ticker symbol ENB. Enbridge Inc. is a multinational energy infrastructure firm headquartered in Calgary, Alberta, Canada. It was originally founded in 1949 as the Interprovincial Pipeline Company and later rebranded as Enbridge in 1998. Enbridge really stands out as a cornerstone in North American energy infrastructure, spanning pipelines, utilities, and renewables. It combines operational scale, a strong dividend history, and a forward-looking commitment to sustainability, offering both stability and growth potential for investors. Now, I really think that these types of companies are going to do well with the new kind of AI training. I think that there's the potential for these companies to make a lot more money because they're essentially collecting a toll for any natural gas that they're moving. And Enbridge is a very strong one. Here are some of the strategic positioning and financial highlights of Enbridge. Enbridge moves nearly 30% of North American crude oil and 20% of U.S. natural gas, a testament to its scale and importance in energy delivery. The company is pursuing decarbonization by targeting net zero emissions by 2050 through expanding its low-carbon energy technologies like hydrogen and carbon capture. Enbridge maintains a strong investment profile with a solid dividend yield of around 6%, a 30-year streak of dividend increases, and an investment-grade credit rating of BBB+. Enbridge forecasts EBITDA growth of 7 to 9%. I don't really care for EBITDA growth or EBITDA in general. I think that in the words of Charlie Munger, whenever you see the words EBITDA, just replace it with bullshit earnings. So I'm not really hyped on the EBITDA portion of this. Q2 2025 results, beat expectations, driven by gains in gas transmission, utility acquisitions, and renewable investments, including a 600-megawatt solar project in Texas. It also approved sizable capacity expansions. So I think that the company's in a really good place, but it is unfortunate that, it's a Canadian natural gas company in the Trump era. So I think that there could be a lot more value here, but also a lot of risk here potentially if the tariff war kind of continues. The stock currently trades for $46.99 per share. The company currently has a market cap of $102.55 billion. The price to earnings ratio is 22.66, which does seem a little bit pricey to me for this kind of business. The dividend yield is 5.83% annually. The 52-week high is 47.44, and the 52-week low is 38.44. So we are a lot closer to that 52-week high for sure. And you can kind of see that reflected in the actual graph as well. The quarterly dividend amount is about 68 cents per quarter. Analysts are generally pretty split on this stock. As you guys can see, it's pretty much 50-50 between strong buy and hold and underperform. And the analyst price targets range anywhere from 43.13 to 49.02. So you're probably not going to get too much volatility. Obviously, the price of petroleum will affect this stock as well, and natural gas. So those things do kind of affect Enbridge in a big way, but as long as demand for energy is going up and the need and the consumption for energy is going up, I think that Enbridge is going to be extremely successful, and they are very poised and set up to be able to be successful going into the future. Here we can see that we have a weighted average cost of capital of 5.21%, which is otherwise going to be applied here as our discount rate. I really wanted to highlight here that the debt to equity ratio is not very favorable, and that BBB plus rating is not anything to write home about. I don't usually like companies that are more debt weighted. I know that obviously the cost of debt after tax is lower than that cost of equity. But if they run into problems or natural gas demand goes lower, like what happened during COVID, where a lot of businesses didn't need as much, there just wasn't as much of a demand for energy in general, that could really hurt a company like Enbridge. Really just any kind of shock to demand, tariffs could really hurt them as well. And I don't like when a company has a lot of debt like that, and there's a chance that things could go really awry. So that's just something to kind of think about. Here we have the average revenue growth at 9.55%, average free cash flow growth at 110, but that's kind of irrelevant because they could be paying debt or paying off certain pipes for a certain quarter. There could be a lot of reasons that the cash flow is growing at that extreme amount. We can see that this from 2021 to 2022 was an extreme outlier year. But I put in a growth rate of 4% on average over the next 9 years, and there's 2.79% downside on that. I think if we did 9.55%, we could see that it would be 101.56%, which is the historical revenue growth rate on average. But it does look like from 2022 to 2023, we did have negative 18.12% revenue growth. So I think that something more realistic would maybe be like 5 or 6%. 4 would be really just playing it safe, but I really do think that you could do 4.5 and very much justify that. And that would mean that this is selling at a 5% discount according to my model. Now, I would not want to touch this particular company just in general because I am an American and I am kind of worried that there are going to be special taxes or other special threats or things that are going to happen to the Canadian companies, and the picture's not really clear to me. So I would personally not want to enter for that reason, but I always look for a reason not to invest. I do think that this does look cheap, and if you want to ride it out, I think that you're probably going to be correct to do that. I think that they're going to be able to continue to increase that dividend, hopefully be able to pay off more of that debt, and just return a lot of equity to their shareholders. One thing I didn't really talk about this business is that it is very inflation proof, because once you spend the money to put the pipes in the ground, then you've already spent that money. I mean, the amount's not really changing for your loan or whatever it is. And with the high amount of debt too, it does seem like we're on the right side of interest rate cuts. So I do think that's going to be a positive for Enbridge because they're going to be able to maybe refinance some of their loans. But if there are big tariffs against them, I think that's really going to hurt their company. They're probably going to end up passing that on to the consumer, but that's not really something I'm very excited for. But my conclusion is I think that this is probably pretty cheap. I think that realistically we could expect to see a 6% growth rate, which, that would be on the higher end for sure, but that would mean a 30% upside. I think it's definitely possible, but there are too many risks for me. Personally, I would rather own something like waste management. I definitely want to own more of that. But Enbridge, I still think is, a risky play that you can make a lot of money on if you're right. Thank you guys for watching. Thank you for watching to the end of the video. I really appreciate it. Please hit that subscribe button if you enjoyed the video, and have a great rest of your day. Bye.